As stocks look to hold on to gains, today's action mirrors a familiar pattern. It's driven by tech stocks. Our next guest sees market breadth flashing a warning signal for the S&P 500. For more, we bring in Joe Mazzola. Joe, great to speak with you. You're the, of course, head of trading and derivatives at Charles Schwab. Just want to get your sense here. We keep worrying about breadth, but the tech rally continues. Does the breadth zombie matter so much if tech can keep this rally going?
You know, I think it matters in earnings season, and here's why I say that, because look at the strength of the dollar that we've seen just really from October through where we're at right now. We've seen about a 7% rally, kind of not given some of the weakness today, but you know that could affect some of the tech earnings. You know, you're looking at markets where 50-60% of the revenue for some of these mega cap companies is coming overseas. Could be something that factors into the earnings, and what we would need is we'd need, you know, the rest of the 493 stocks to kind of catch up, and kind of given where analysts' expectations are for next year in terms of about 11 or 12% growth in the S&P 500, you're going to need to see something that's going to pick up that earnings, and it doesn't mean that we can't have another year like 24 where, you know, tech led the way, but it does mean that a broadening would help. And where we're at right now, about 23% of the S&P 500 above the 50-day moving average. It doesn't show that the market's selling off. It just shows that, you know, we're building a base a little bit, and then I think earnings will be the catalyst to either push that higher or you know, have that come down a bit.
Yeah, Joe, that was going to be my exact question. When you talk about what is going to be that catalyst in order to get maybe broader participation, you just mentioned earnings there. What type of growth do we need to see beyond tech in order to convince the market that this rally does still have room to run?
I think it starts with the financials. I think those will be really important. And I forecast that the financials will have pretty darn good earnings. I mean, just look at what we've seen in the steepening of the yield curve. I think there's some excitement around deregulation, what that could mean for M&A activity. So if you get favorable reports from the financials, which I said is kind of my expectation, I think that kind of kicks off things a little bit, and that'll start next week, and we'll see kind of how that carries forward. But you know, they're going to be important right away.
If yields are a tailwind for financials, are they also a headwind for the likes of large caps and tech?
They could be, and here's the reason why. Maybe not the Magnificent Seven just because of the cash that they have on hand, but if you're looking at investor dollars, right? I mean, every investor has a choice. Do they want to put it in the equity market? Do they want to put it in the bond market? Do they want to keep it in cash? And where they're getting 4% and higher yields on cash, you know, there is sometimes, especially given the fact that we've had 20% year-over-year growth in 23 and 24, or excess of that. You know, there is a tendency to say, hey, what's going to happen in 2025? Should I park a little bit on the sidelines? What we're hearing specifically from our clients is there's a little bit less bullishness heading into this January than there was at the tail end of the year. Now we're seeing that, and that a lot of that started in November. And what I found was really interesting is, you know, we talk about our stacks report, right? That's our Schwab Trading Activity Index. And what we look at is we look at what clients are actually doing in their portfolio. And in November, I thought this was really key. As the market rallied, clients were trimming into that strength. We actually saw the widest gap that we've seen between our stacks and the S&P 500. That caught up a little bit in December. The markets pulled back, and our activity index actually went up a little bit. So that did kind of cut into that divergence a bit. But what that was telling us is that, you know, clients were already kind of starting to do a little bit of a portfolio rebalance at the end of November, heading into December, maybe paring back some of those higher beta names.